Meaning, and the point that I'm making here, is that they will purposefully do things that will draw the typical general public, let's say the general public, into the other side of their trades, when in fact what they want to do is the exact opposite. For an example, let's if I'm a hedge fund manager and I'm long stocks, or it doesn't really matter what it is. I could be long bonds, I could be long gold, I could be whatever it is, and I want to liquidate my position. Now I've got a huge position, meaning I've got a cash position and I want to sell it. If I go into the market right now and sell my entire position, what do you think is going to happen to the price? Chances are it's going to go down. I am actually going to, because of the volume of my trades, I am actually going to drive the price down, making my average cost lower and lower. I don't want to do that. I don't want to, so for an example, if I come into the market and I say, hey, you know what, I've got 10 million shares of this and that to sell, what's going to end up happening is that those 10 million shares are going to end up taking out all the bids, all the prices down, take out all the bids until you find a spot where it can't take out, where the size of the trade cannot take out any more bids and the price stabilizes. Okay? So I'm thinking to myself, now, what you get is you got these, what I'm going to call like these hot shot kind of hardcore traders, where, you know, to make a name for themselves, because they're in a big trading room and they compete amongst one another and their bonuses depend on how well they do. What if they did something like this? I'm looking at a price chart. Let's just say they can be daily bars or whatever. Okay, and this is like a swing high, swing low, okay? Now, interestingly enough, as we're talking about this, I want to make a point about what does this price represent right here, and what does this price represent right here? What? Yeah, we're going to call it resistance, but more from a practical matter, what does it represent? What's that?
Nobody believes it's going to go higher.
Ah, yeah. In other words, there wasn't. Now, you're right. He said that nobody believes it's going to go higher. It represents there wasn't one person in the whole world, that was willing to bid the price one tick higher. Not one. Up to this point, there could be any number of people who were willing to bid it higher. But it got to a certain price level, and there wasn't one person left in the whole world that would bid it higher. This, by the way, is one of the reasons why technical analysis works, is because the market has a memory. This is why technical analysis works. The market has a memory. Because when the market came back down, you formed a swing low, came back up to this high, there were people who made money by selling this high. There's a good chance those same traders are going to come back into the market and do it again. As well as there are people who lost money by buying that high. Because for every trade that was made up to this last price, there was a buyer and a seller. There was a trader on the other end of the trade that bought that high. Now when the market comes back again to the same price level, chances are there will be an imbalance between the buyers and the sellers. Just by the mere fact that the people who made money are going to be willing to trade it again and come into the market maybe with a lot of ferocity. And the traders who lost money by buying that high are probably not going to be willing to do it again. And so what you have is even more of an imbalance that existed the last time. Are you guys with me on this?
I'm waiting for it to break through.
Okay, well that's fine. You can do that. However, no, I'm not going to really the most I'm going to do is get into what we're just doing right now, because this is not, this is not a course in technical analysis. I mean, and it doesn't really matter anyway, because you guys are trading off of mathematical formulas and not doing subjective trading. So, and this would fall into the category of subjective trading. Subjective trading also is the equivalent to like who watches Texas Hold'em tournaments like on TV? Anybody? Come on, give me more of a show of. So you've got categories of development where initially people, when they play Texas Hold'em, you play your cards, and then you get well enough, you get good enough at playing your cards. What you start doing is playing the people, and you get good enough, you get so good that you don't even have to play your cards. You don't have to look at your cards. You just play the person. That's the equivalent to subjective trading. Okay, what you're doing is you're using a process of deductive reasoning to determine who's thinking what and what they're likely to do. Okay. And the only reason I'm giving you all this information and making this point is so that you understand with no uncertain terms that there's a whole category of traders out there, people out there, traders, people who have both the financial and the psychological resources to bid markets up and offer them lower. And what's the point that I'm making? The point that I'm making is that any particular technical methodology that you use to determine a pattern is present that gives you a higher probability of one thing happening over another, until you can get into the minds of the people who actually move prices, you will never know for sure what's going to happen next. The only people that know for sure are the people who are willing to do it. And that's what you got to burn that in your brain. You will never know for sure what's going to happen next, unless you can read the minds of the people who are going to do it. And there are people who will do it. And they do it all the time. That's the only way you end up in a winning trade. Most of the time when you end up in a winning trade is because of what these other dynamic traders are doing. So to convince you that there are people who are willing to do this, if I'm a hedge fund manager and I've got to unload a huge position and the market happens to be sitting right here in relative to this chart pattern, how might I maximize my profits? What might I do? Now remember, I've got to sell. I'm going to be a seller. But what might I do to make sure that I get the best price? What?
Drive it up and sell.
Yeah, drive it up. In other words, I will do the opposite of what I want to do to get a better price. And I will drive it up. But how much risk am I taking by doing that?
Probably not a lot. If you're selling just a little, drive it up and sell a bunch coming back down.
Well, yeah, I mean, if I drive the